studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that sunky died.
As we move into the technical side of the passive income grind rules, we need to understand two important tax concepts: aggregate investment income, or AII, and adjusted aggregate investment income, or AAII. At first glance, these terms sound very similar, and that's exactly why many students find them confusing. But in Canadian corporate taxation, they serve different purposes. Let's start with aggregate investment income, or AII. Think of AII as the traditional investment income calculation used within the corporate tax system. It includes various types of investment income earned by a corporation and plays an important role in calculating refundable taxes and balances, such as refundable dividend tax on hand, commonly known as ARDTO. In other words, AII is primarily part of the broader corporate tax framework. Now let's look at adjusted aggregate investment income, or AAII. AAII begins with the AII calculation, but then applies specific adjustments. The purpose of these adjustments is to create a special measurement that can be used for the passive income grind rules. And this is the critical point. When the government wants to determine whether a corporation's small business deduction should be reduced because of passive investment income, it does not use AII directly. Instead, it uses AAII. This means that although the two calculations start from a similar foundation, they are not always equal. AII is essentially a modified version of AII designed specifically for the small business deduction grind. A simple way to think about it is this: AII is the starting point, AII is the adjusted number, and AII is the number that ultimately determines whether the passive income grind applies. The process works like this. A corporation earns investment income. That investment income is first used to calculate aggregate investment income. Next, certain adjustments are applied. Those adjustments produce adjusted aggregate investment income. Finally, AII is compared to the annual passive income thresholds to determine whether the small business deduction must be reduced. This distinction is extremely important because many of the planning strategies we discussed earlier depend on understanding which items affect AII and which items do not. If you remember only one thing from this slide, remember this: AII is the starting point. AII is the modified calculation used to test whether the small business deduction grind applies. In the next slide, we'll walk through the actual mechanics of the AII calculation and see how the adjustments transform AII into the number used for the passive income grind rules. Now that we understand the difference between aggregate investment income, or AII, and adjusted aggregate investment income, or AAII, let's look at how the AII calculation is actually performed. The most important concept to remember is that AII does not start from scratch. Instead, it begins with the corporation's aggregate investment income. Think of AII as the starting pool of investment income. This pool generally includes common forms of passive investment income earned by a corporation. Examples include interest income from bank accounts, bonds, and GICs. It also includes portfolio dividends received from investments in public corporations. Rental income from investment properties is typically included as well, and taxable capital gains from investment assets may also form part of the calculation. Once all of these items have been gathered, the corporation arrives at its aggregate investment income. But the process does not stop there. The next step is what makes AAII different. Specific tax adjustments are applied to the AII calculation. You can think of this stage as a filtering process. The government does not want every item that appears in AAI to automatically affect the small business deduction grind. As a result, certain gains, losses, and special categories of income receive different treatment. Some amounts may be reduced, some may be excluded, and some may be adjusted according to special rules found in the Income Tax Act. After all of these adjustments have been applied, the result is adjusted aggregate investment income, or AAII. And this final AAII number is the one that matters for the passive income grind. The government compares AII to the annual passive income thresholds. If AII remains at or below $50,000, there is generally no reduction to the small business deduction. If AII exceeds that threshold, the grind begins. And as AAII continues to increase, the corporation gradually loses access to more of its small business limit. Notice the key idea here. AII is simply the starting point. AAII is the refined calculation that emerges after the adjustment process. That's why two corporations with similar investment income can sometimes have different AII results, depending on the nature of their assets and the adjustments that apply. For exam purposes, and for practical tax work, remember the flow. Investment income is earned. Aggregate investment income is calculated. Adjustments are applied. Adjusted aggregate investment income is produced. And AAII is then used to determine whether the small business deduction grind applies. In the next slide, we'll focus on the specific items that are commonly included in AII and the items that are excluded or receive different treatment. That distinction is one of the most heavily tested areas of this topic. Now that we've seen how adjusted aggregate investment income is calculated, the next step is understanding which items are included and which items are excluded. This distinction is extremely important because the passive income grind is based on AII, not simply on every gain or income item reported by a corporation. Let's begin with the items that are generally included in AII. First, there is interest income. This includes income earned from bank accounts, bonds, GICs, and other interest-bearing investments. Interest income is one of the most common forms of passive investment income and is typically included in the AAII calculation. Second, we have portfolio dividends. These are dividends received from investments in public corporations, mutual funds, exchange-traded funds, and other portfolio investments. Because these investments are generally held to earn investment returns rather than to support an active business, they are normally included in AAII. Third is rental income. When a corporation owns rental properties that function as investment assets, the resulting rental income is generally considered passive income and forms part of AII. And fourth, taxable capital gains from investment assets are typically included as well. For example, if a corporation sells shares, securities, or other investment property and realizes a gain, that gain may contribute to AAII. Now let's move to the other side of the slide. These are items that are excluded or treated differently. One of the most important categories is active business assets. Assets that are used primarily in carrying on an active business receive special treatment because they are not considered passive investment assets. Think of equipment, manufacturing facilities, inventory, or property used directly in business operations. Similarly, gains arising from the sale of active business property are often treated differently from gains on investment assets. The government recognizes that selling a business asset is fundamentally different from earning passive investment income. Certain capital loss adjustments may also receive special treatment within the AAII rules. This is one reason why AAII can differ significantly from the corporation's accounting income, or even its aggregate investment income calculation. The key principle is simple. AAII is designed to measure passive investment income, It is not designed to measure income generated from active business operations. That's why tax professionals always begin by asking a critical question. Is this an investment asset or an active business asset? Because the answer to that question often determines whether the income, gain, or loss affects AAII. For exam purposes, remember the basic pattern. Interest income, portfolio dividends, rental income, and investment-related capital gains generally point toward AII. Active business assets and gains connected to active business operations generally receive different treatment. And that brings us to the most important takeaway from this slide. Always identify the nature of the asset first. Once you know whether an asset is held for investment purposes or used in an active business, you'll be much closer to determining how it affects the AII calculation and, ultimately, whether it contributes to the small business deduction grind.